Okay, it's 11 on the dot. Let's get this presentation started. Welcome everyone to this TradeStation webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. As you can see, I'm joined by my colleague, Brandon Wendell. He's not affiliated with TradeStation, but he's a guest speaker today, and we're glad to have him. I'll pass the microphone over to him in just a moment. I just have to take care of some, introductions and disclosures. So hang on tight with me here. This is lesson 2 of a series. It's a 6-part series on future spreads and futures options. The highlighted platform here is FuturesPlus. This is a platform that TradeStation provides to those that are interested in trading future spreads or futures on options. If you guys have any questions on account opening process, we have a team dedicated to answering your questions. Just give them a call and get somebody on the phone, and they'll explain, the process and how to get this started. If you are already a TradeStation client, you may be already trading on the TradeStation desktop, but just think about this as a separate platform that we provide for trading exclusively those two products, future spreads and futures options. Today's presentation is around futures spreads and some advanced trading techniques that Brandon is going to show us. So we'll get to him in just a moment. For disclosures, just keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, especially when it comes to trading options, which carry a high degree of risk. And also, past historical performance is no guarantee of future results. If we go over any trading example, it is precisely that, just an example. And I also want to note that I said that at the beginning, that Brandon, even though it's a pleasure to have him, he's not affiliated with TradeStation, so his teachings and his methodologies are his own. For additional information on these disclosures, please go to www.tradestation.com/important-information. All right. Well, thank you guys. Let me go ahead and stop my share. Before I stop my share, though, let me show you where you can access the series and the recordings of this class. Let me go ahead and share a link right here in the chat. It is the Futures Education Center. We are in the process of developing a lot of educational content around futures, future spreads, and futures options. So make sure you click on that link and explore some of the items that are already there. In terms of what we're doing in this series, I did point out that this is lesson number 2 of the series. When you land it right here in the Futures Education Center, scroll towards the bottom, and right under this blue box for the Futures Options Replay, we have the FuturesPlus Masterclass. So this lesson 2 is part of this series. As I said at the beginning, is a 6-part series. We already did lesson 1, so you can come here and watch the presentation for lesson 1. It's already recorded, and we have the archive posted on this page. As you can see, lesson 2 still has the register for this webinar because it's happening as we speak today. But once the webinar is finished, we'll post it here, and you'll have access to a recording that you can watch at your pace and your convenience. But make sure that you bookmark that link that I just shared with everyone. It is the Futures Education Center for access to the complete series, okay? All right, let me go ahead and stop my share and introduce you guys to Brandon Wendell again. Brandon, thank you so much for being here with us. The floor is all yours, okay?
All right. Thank you very much for having me. Appreciate it. There we go. So should be able to see my screen, and let me make sure I got the chat going here as well, so I can go ahead and monitor that as well for any questions you might have. As Jesus mentioned, I am not an employee of TradeStation. I was just invited to go ahead and speak with you guys about spread trading of the futures markets, because that's what I do for a living. Full-time trader and part-time educator when it comes to the markets. I specialize in futures, futures options, and future spreads. I'm a charter market technician, which means I've got a lot of education in the technical analysis realm, and have been through a lot of different types of analysis and figured out a lot of things that work, what doesn't work, and try to use that incorporated in my teachings and my education that I do. Not really here to talk about myself too much. I was actually in back office operations for a brokerage. I led a hedge fund for a while, and now I simply trade for myself because it's much easier, and I like to share my knowledge with fellow traders like yourself. So, as Jesus mentioned, this is lesson number 2 And we are kind of picking up where we left off. If you're not familiar, we talked a little bit about spread trading on futures, which is not anything to do with options. Okay. When we're dealing with spreads on futures, we're simply trading one futures contract against another. And there are definitely pros and cons when it comes to any kind of trading, especially if it's something new to you. The nice thing is that with these spreads, we're pretty much market neutral. So it doesn't matter if the markets are bullish, bearish, or even choppy sideways. This can be a strategy that can be employed in pretty much any market condition. What we're trying to do is take advantage of mispricing between two related securities. And, it's because we're both long and short. We're basically delta neutral, which reduces our directional risk when it comes to the market. So if we're worried about a bullish move or a bearish move, it doesn't really affect us too much as long as we are what we call delta neutral in our positions. We do have a little bit of management of our drawdown. So you can lose money in spreads. Absolutely, you can. There's definitely still risk, but because you're long and short at the same time, albeit different securities, it may be related, it typically would reduce the amount of drawdown that you might have compared to simply trading directionally in the underlying futures. So again, it's just a little bit different. And the other nice thing that attracts a lot of people to this is the margin requirements are much, much lower than what it would be if you simply traded individual securities. So you can do this in retirement accounts or in smaller account sized accounts. Just got to keep in mind that you need to have enough capital to cover any possible losses or any kind of black swan events that might occur. So obviously not everything works all the time because we have correlations that we're dealing with. They work more often than not, but they never work 100% of the time. Yeah, I always say everything in technical analysis always works except for when it doesn't. So it definitely doesn't work 100% of the time. Obviously, you got to pay more commissions if you're trading more than one security instead of just buying the NASDAQ. If you're buying the NASDAQ and shorting the NASDAQ different months, then you've got extra commissions that you wouldn't normally pay if you just did directional trading. You got to be careful with liquidity because often when we do these spreads, we may go out further in time for expiration. And when you do that, the lower volume on those contracts sometimes gives you liquidity issues where there may not be as good of a spread. The bid-ask spread might be wider, or you might have problems getting filled on a contract that's only trading 12 to 15 contracts a day. So you got to be careful of that. And you got to make sure you understand leverage properly because leverage can be a great thing. It increases your buying power and allows you to trade something of much higher value using a lot less capital, but it also elevates your potential risks in the markets and your losses. You can't have greater gains without greater risk. They go hand in hand. So we got to be mindful of the leverage we're using and use it wisely. So again, when it comes to these spreads, instead of just going out and trading a NASDAQ contract long, because I use that as an example, this is TradeStation Futures Plus. And what I could do here is, increase the size of my chart for a moment first. And I'll just bring in a new chart and Q. And let's see, we'll do the June 2025 contract. And it'll take a few moments for that to load. But that is just the normal NASDAQ future. Let me increase the font here so we can actually see what's going on there. There it is. And there's the contract. So I could trade this either long or short or whatever I want to do. But another thing I could do is create a spread and trade the spread instead. That was not meant to rhyme, but it just happened. Okay, so if I go in right here, NASDAQ future spreads, see if it shows me. Perhaps I want to do the June versus September calendar spread. And there it is. What you'll notice between these two, there's the NASDAQ, and I don't know why it's taking a while to load it again, but it will load. And of course, I had the spread. They'll look very similar to each other, but the prices will be completely different. You can see the single contract is trading around 18,368 right now. And obviously jumping around a little bit. And again, the contracts, they'll populate. There it goes, finally. It'll keep loading up. There it goes. But when I look at the spread, this is a chart of the June minus the September contract. And you can see the price difference is being shown. So the June contract is 176 points higher than the September contract right now. And that is the spread that we're charting. It's the price difference between the two. But we can trade this the same way we would trade anything else, supply, demand, trends, all that good stuff. But the margin is going to be much, much lower on this. And to get the margins, TradeStation uses a span margin. So I actually go out to the CME group. I think I might have mentioned this before. If not, we're going to do another section on margins as well. But you have to create an account here. So I go to my CME customer center and it's going to ask me for a duo push to log in for protection. So let me get that ready here on my phone. There we go. Good security. And now I'm in. So if I go to portfolio and risk margin calculator, this is how we calculate our margins. Again, I go margin calculator, futures and options. And if I want to trade the NASDAQ itself, I mean, that's pretty easy. I just go ahead and load up. Just do NQ. I have to put in a number here for the account ID and the firm ID. Just put in 1. And now I'm just going to go ahead and put in NQ, and we're going to trade the June contract, long 1, given margin, and it should show me the report in a moment. And you can see that the overnight margin right now for the NASDAQ is $34,106. As a matter of fact, let me do something else here. Zoom it, that open. Let's see. Yep, it did. So you can see right there, my initial risk margin is 34,106. Now, if I want to do a spread, instead of buying just the NASDAQ, we can go ahead and bring this back up again. And I'll do NQ spread. And once again, we'll bring up NQ. And we're going to do, once more, the June contract, long 1. But we're also going to do the, nope, I want September. There it is. September contract and short 1. So it's doing the report right now. And if I want to hold both of those overnight, take a look at what the margin is. Not 30,000. It's $315.80 to hold that overnight. Long 1 and short the other. Now, probably thinking, why the heck would you want to do that? Well, if the prices are moving up, typically the front month, which has more volume, might move up faster than the back month. And that's how we would profit. Again, it would all come down to, what are we seeing on our chart here? If that chart is going to be going to the upside, we would buy the spread, and the point values here is the same. It's $20 a point on the NASDAQ. It's $20 a point on the spread. So we could possibly see that moving to the upside or to the downside, and we could possibly short it. So the margins are much, much lower and gives us an opportunity. That's a bull spread. If we buy the front month while selling the back month, you're basically anticipating that the front month will move up faster than the back. And we profit from that moving faster. And as you saw, the margins are ridiculously low. That also means the risk is much lower and the reward will be much lower. You're not going to get the same type of rewards as if you bought the NASDAQ and used $31,000 in margin. So if the trade does lose money, if the back month rallies more than the front, and of course, the profits, as I just said, will be much, much smaller than if you did directional trading instead. But it can make good rates of returns because the margin requirement, as you saw, is so much lower. Our margin requirement, $315 versus $31,000. So we could make decent returns on our risk. The commissions are going to be double. Yes, I mentioned that earlier. Because you're trading more than one contract, you got to pay for each of those contracts. So yes, you'll double the commissions. But the commissions are relatively low anyway for futures. You know, when you're trading futures and FuturesPlus, again, I don't know exactly what the commissions are, but they're relatively low. So again, if you're buying the bull spread, in this case, we were expecting December contract to go to the upside. You could buy the front month, and this was December live cattle, and the margin at the time was $26.95. But instead, we could buy the front month and sell the back month. So in that case, I was buying December 2024 and selling April 2025. The margin was only $1,200. So I cut the margin requirement in more than half. Trish, yes, the tax rules still do apply to options on futures and on spreads on futures. Remember, we're not dealing with options here today. We will cover that in a future session, but this is simply trading futures as a spread. So we're buying a futures contract and selling a futures contract. But yes, it all works the same way. They're still 1265 contracts. I totally forgot the number now. Anyway, the taxation should work the same way. Verify with your tax professional. I am not a tax professional, so I can't give you definitive answers there. Okay. But yes, typically options and futures are taxed differently, that 60-40 rule. So we could also do a bear spread if you expect the front month to drop. In this case, I was expecting corn futures to drop. And instead of selling the corn futures, which alone I'd have to put up the margin for that, which is about $2,000, or I could do the spread where I sell the front month and buy the back month. In this case, it was December 24 versus March 2025. And the spread also moved down because the front month moved faster than the back month, which is typically what will happen. The front month has more volume, and because of more volume, more liquidity, it typically will move faster than the back months. And you can even see this if I go back to the CME website, and let's say we go to markets here, and I'll go to nat gas as an example. Getting a quote on natural gas, just to see what it's been doing today, you can see that our front month, May, is still the front month. It's down 0.035 or 1.16%. Actually, the back month moved further. The June contract went further and faster. Although, if you did, I think the volume might be rolling over soon. Yeah. Anyway, you can see that that moved a little bit further than the back months. So if you were expecting nat gas to go to the downside, you could have sold short either the May or the June contract. In this case, let's say you did the June contract, you sold the June and bought the August contract. Well, you'd lose on the long, but you profited on the short more than you lost. Net, you'd have a profit. However, if you did it with this contract, which is actually the front month, you would have lost money because that didn't go down nearly as much as the back month did. Okay. I'll just round figures and let's see. It is pretty close. It's not always the same 1/100th of the position for the margin. It varies depending on what it is you're trading. And that's why I use that margin report right here. Again, so if I were to go out, let's say to another security, let's do live cattle. Okay, so I'll go ahead and do live cattle. You can name it whatever you want. That doesn't matter. And again, I go here to product name. We'll do live cattle. There we are, live cattle futures. Brings up the clearing code for me, or should. Oh, no, there we go, LC. And we'll just do June, long one contract, add to preview, save and margin. So the margin on this one should be coming up in a moment. Actually, it won't because I already had the other one checked. So now I got to click on reports. Not a big deal. And there it is, $3,025. However, if I want to do this as a spread, I go back, LC spread. I don't know why you have to, but you got to put some number in that firm ID and the account ID in order to get this working. Anyway, again, I'll just do LC, live cattle, and I'm going to do, again, the June contract long, but then I'm going to add in the August contract and we'll short that one. So we're buying one contract and selling the other. Save and margin, and it was $3,000 for the full-size contract. For the spread, it is $550. So no, it's not always 100 to 1. It varies depending on what it is you're trading. But there's our initial risk margin and then the maintenance margin, so you avoid margin calls. Okay, so you got to check each individual security, whatever it is that you happen to be trading. Here it shows you the margin results on each of these as well. So actually, no, it was 34,000 for the NASDAQ and now only 315 overnight. Anyway, you get the idea. So the thing is, I could use a spread trade as a substitute for a directional trade. That's the main takeaway from this. If I'm doing spread trading or if I'm doing directional trading, I think that the NASDAQ is going to go down, or I think the Dow is going to go up, or I think that crude oil is going to drop in price. I could actually put on a spread, either a bull spread or a bear spread, depending on which direction I think, and I won't make nearly as much profit as if I just simply bought or sold the underlying security. However, I will have a much lower margin requirement and my rate of return on that capital might be much higher. So that's one of the big advantages of doing this. Plus, I have some directional protection in case it goes against me. Whereas if I simply bought a contract, or in this case, shorted a contract, if the prices went up, I have zero protection. But if the prices go up against me in a spread, it may not hurt me as much because I'm both long and short. As far as the symbols to find them, well, the easiest way to find them is actually on the TradeStation website, to be honest with you. If you go out to TradeStation and under pricing, futures margin rates, okay? If you go to futures margin rates under pricing on the TradeStation homepage, right here, you'll see symbol root. Those are the symbols that TradeStation uses for all these securities. Go to currencies, and you can see that they're using the pit symbols like AD, CD, EC. Those are a little different than the Globex symbols that some other places use. So if you want to know what symbols you need to use for TradeStation, they're actually same ones that are being used at the CME as well. It's just that a lot of brokerage platforms don't use these pit symbols. They use the Globex symbols only. But these are actually the right symbols to use if you ask. I mean, technically. They're both right, I suppose. But yeah, these are for the outright futures. Exactly. Okay. And the spreads are the same. Basically, you're doing one minus the other. That's all. Yeah. The spread symbol is just simply one minus the other. Now, again, if you're trading TradeStation Futures Plus, there's a couple different ways of building these spreads. If I'm charting it like this, you saw all I had to do is click on the plus symbol here, search for an instrument. Let's say I want to find lean hogs. I start typing in lean hogs, and there it is. That's the outright future. There's the spread. Okay, don't use the TAS future spreads. Use this one. If I click on that, Okay, now it says press enter for results. And as I zoom in here so you can see it, whoops, there we go. You can see I can choose whichever calendar spread I want that's available here. That's one way of doing it. I just bring them up on the chart. Now, if I want to bring up an intermarket spread, right now we're talking about intra, they're the same symbols, right? The same underlying symbol. So again, if I want to do that one more, let me bring it up actually. Clean hogs. Again, I click on these spreads, hit enter, and let's say we want to do, August, May. It's out a little bit, and that should be loading up the chart. It's not going to load it because it's not available in that one apparently. So that's one way of loading up these charts, again, by doing bring up the intra-market spreads. Another way of bringing it up is what's called the auto spreader. This is one of the widgets that I brought up right here, the auto spreader, and we can create our own spreads. Now, I can do the intra-market as well. Okay, you can also, another widget would be I think it's product grid, or is it market grid? Market grid, I could do the spreads there as well. CME spread, and let's say we want to do Dow. So type in YM, nope, type in Y and go to YM. There we are. And I can see the different spreads there. I can choose one of those and it'll actually bring up the grid. Or right here with the auto spreader, I hit create. And now this is kind of interesting. With this create, I give it a name for the spread and I choose the two different legs that I want to use. And it'll create the symbol and the charts for me if I want. So let me show you how that works. Say I want to trade gold versus silver. There we go. That just popped up. All right. So I think I already have one name that. So I'll name it gold versus silver 2. There we go. And I can share it publicly or I can keep it just for myself. Leg 1, I type in gold. And remember, I can look up the symbol or I can just type in gold and it brings them up. So I can see gold 100-ounce futures. That's the full size gold. Or I could do micro. We'll do the micro ratio. A second. I got to actually pick one of these. MGC June, showing the April. And actually, I click on it again. Notice I'm already on MGC. I can actually just change it. There we go, to June. Okay. So that's the outright future, number 1. And then for silver, I just do the same thing. Type in the word silver. If I don't know the symbol, it brings them up. I'm doing the micro. So right there it is, SIL 1000 versus the 5000 full size. So, whoops, didn't mean to do that. SIL, and I can go to July, and there they are. Now, one more thing I need to do, because basically when it comes to the ticks, they're not the same, are they? Okay, so ratio, that's how many contracts I'm trading, 1-to-1, basically, in this case. Multiplier, though, I need to multiply by the point value. Remember, when we're trading intermarket spreads, we have to do the notional value, okay? And the outright future just means the individual future itself, single contract. Spread would be the two against each other. That's outright, okay? Yeah, single versus spread, exactly. That's what I mean. So right here, the multiplier is simply the point value. And I don't think it shows it in here. No, it doesn't. If you don't know the point values for the futures, you can look those up as well. They are in the contract specifications on the website. If you go to, for instance, markets, gold, well, that's the full size gold. You can go to the specifications, and I can also do the other product to look there. So, whoops, not there. Going back. The multiplier for gold is 100 because it's 100 per ounce. Or sorry, no, it's not 100. This is the micro. So we're dealing with 10. And for silver, actually, that one is not 5,000, it's just 1,000. And you can see the deltas change. And I'm not going to worry about delta neutrality right now, but I'm just going to go ahead and create this one, save. And it should show up. There it is, gold versus silver 2. And I can click on this and open either an MD trader to trade this or simply open up the chart. And I can open up the chart or market grid with legs, all kinds of good stuff. But I'll just open up the chart right now, and there's the gold versus silver chart. That's the intermarket spread using notional value. So notional value is the actual value of the underlying contract. I mentioned this before in the previous class. So when we're dealing with intermarket spreads, that's its intra, that's easy because it's the same. But when we're dealing with intermarket, let's see, where's it here? We'll come back to this in a moment. No, I don't have it on here, do I? I was looking for, there we go, intermarket spread trading. And that's when we're trading related contracts, not the same. If you're trading singles on TradingView, I mean, it's very similar on TradingView as well. You just have to type in the symbols. This is actually a picture of TradingView that I have here. And what you'll notice if I zoom in, this is, oops, where did that go? Wrong one. There we go. Nope, it won't let me zoom. There we go. So you can see that's NQZ24 times 20 minus 3 times RTY Z24 times 50. Basically, what I had to do there is not only do the notional values, but I also have to do what's called delta neutrality. So some of these spreads get a little more complicated, a little more sophisticated, I'll call it. As example, let me just show you. If I go back again, and I'll use TradingView as an example because I can. And I think I'm just on a free chart right now. I don't think I logged in. That's okay. I don't need to. So if we're looking again, I'll just use NASDAQ as an example, NQ 2024. What happened there? Not it. And I'm just going to keep this on the basic chart for right now. There is the NASDAQ. And you can see the market price for the NASDAQ. Let's see, where's it here? Where the font is now. Maybe I should log in so it looks better. Anyway, just bear with me. Sorry. Yeah, it's okay. I'll just leave this. Anyway, this is what's called the market price, 19,747.25. Okay, that's the market price that you're seeing on the chart. This is 19,747. I'm just going to leave it at that. Okay. Now, the notional value is that market price times the point value. So in this case, we have 19,747 times 20. Basically, one NASDAQ contract is valued at almost $400,000. That's notional value. So if I want to trade the NASDAQ versus the Russell, remember the Russell doesn't have the same point value, does it? The Russell has a point value of 50, and the volatility and movement of it is different. So what I have to do is if I go back to margins on the CME website, this is where it gets a little more tricky. Let's actually go to CME equity index, and why is it not showing me? Let's go all exchanges. See if that does it. Nope. All right, so we're gonna have to do this a different way. It's not cooperating today. Go back to the NASDAQ. I'll go to margins. It brings up the NASDAQ margins anyway. That's why, because I was in the wrong spot. This is outright. Again, outright simply means the individual future. And you can see it shows me the maintenance margin. Okay, remember, that's not the initial margin. Maintenance margin is what you need to maintain equity of in your position so you don't get a margin call. To figure out your initial margin, you can use that margin calculator or simply multiply whatever number you have here by 1.1. So basically, that's the relationship between initial and maintenance margin. 31,006 times 1.1 is 34,106, which again, going back over to our margins here, there is the margin 34,106.43 for the NASDAQ. It's simply that number times 1.1. Okay. Now, intra, that means the same security against itself. NASDAQ versus NASDAQ. Notice the months are different here. That's a June versus September spread. And again, the maintenance margin 287 times 1.1 is 315. And again, if you go back over to my spread here, the NASDAQ spread was how much? $315. But here's where it gets a little tricky. Intermarket is related securities. And what you'll notice, if I go back to intra, see it says ratio, it says -1, 1, 1, -1, 1, -1. Basically, you're going long one contract, short another, and whatever months. So if you want to trade the June versus December, the margin is over $800. If you want to trade June versus September, the margin's cheaper because there's more liquidity on it. Now, when we go to intermarket, what you'll notice is it says ratio, and here, look at this, 3 minus 2. What does that mean? That means you cannot trade, well, you can, but it'd be incorrect. You could trade 1-to-1, one NASDAQ to one ES, but it's not correct. Because of the point values and the notional values and the movements of these underlying securities, you need to ratio them out so you're delta neutral. That means if the markets crash altogether or they rally real strong, you have no exposure to that market. You're delta neutral. The only thing you're actually trading in this case is the relationship between those two changing. Either the NASDAQ or the ES moves faster or slower. Okay, so when I look down here, if we go, you can see the ES is pretty much always 3-2 against the NASDAQ. And I can keep looking. There's another page, and I just look, there it is, Russell, NQRTY, and we have 4-to-1 if you're doing June versus September. You got to find the right months and the right securities. So there is September versus December. So I just simply find the ones I want to trade. And in this case, here we are, June versus June. I must do a 4-to-1 ratio, Russell versus NASDAQ, if I'm going to trade that. So what does that mean? I go back over to my platform, and I was on the right page there. Hang on. Right here, if I'm going to actually chart and trade this, I'm going to go back to my spread trader, my auto spreader, and create that spread so I can use it for trading. So we're going to do NQ RTY 625. That's the name. Leg number 1, NQ. And I find NQ. Oh, that didn't go. There it is, June 2025. And then the other one is RTY, Russell, again, June 2025. My ratio, though, I have to do, remember, -4 for the Russell. And the multiplier is the point value, $20 per point for the NASDAQ and -50 for the Russell. And you look at the tick information if you choose to, but this would be the correct ratio. So now I save that, and there is this open chart with legs in tabs. So this is the spread chart, I think. Let me see, am I looking at the right one? Yep, this is the spread chart. So font size, come on, much easier here. This is the actual spread chart for the NASDAQ versus Russell 4-to-1 ratio. So if I trade this, I'm basically buying one NASDAQ and shorting 4 Russell, or I'm shorting one NASDAQ and buying 4 Russell contracts. That's the correct ratio to do this. And you saw the margins as well. I can either build the margin myself, or right here, it shows me the maintenance is 19,895. Once again, I can multiply that by 1.1. The initial margin is $21,000 to trade 5 contracts of futures. That's still cheaper than trading the NASDAQ by itself. What am I actually trading? I'm trading the NASDAQ, its movement against the Russell. That's it. So if I think the NASDAQ is going to move faster to the downside than the Russell, I would short. And if this line moves down continuously, I would make a profit. Spread trading futures access to AutoSpreader. Yes, it is only on the, no, this is absolutely totally. This is FuturesPlus availability only. You can't trade the futures spreads on the regular TradeStation platform. If you want to do the spreads, you must do it on this platform, because this is where you have all the access to the auto spreader and all the tools for it. And this is also where you, if you want to do options on futures, you also must use the TradeStation Futures Plus platform. But it's not, it doesn't cost anything extra. You just have to ask for it and fund an account with it. But it's basically a futures account that we're trading here. And of course, if I want to take a look at the individual legs, they are here as well. It's on a 1-minute chart, but that's okay. You see this, the Russell 1 minute, NASDAQ 1 minute, and then the spread, again, 1 minute, or I could change time frames. But I would trade this the same way I would anything else, just using my technical analysis, supply and demand. So going back to my deck here, again, going back a little bit further, intra-market spread trading. If I expect the markets to go up, I could either go ahead and buy the single contract, or I could buy the spread at a lower margin rate and possibly get a better rate of return. If I think the price is going to go down, instead of trading just a single contract, I could create a spread. In this case, it was crude oil spread, where I'd short the front month, buy the back month, and still potentially profit from the move, okay? Or I could, again, I could do either the spread or the single. Yes, you can automate a lot of stuff in there too. I don't have all the tools set up right now, but there's a lot of tools that are available here, especially with the order routing. Again, if I go back and bring in Open MD Trader, you can see it's kind of a matrix that goes on here, and there's a lot of different types of orders that you can put in. I don't have it all set up right now, but yes, there's a lot of different tools, just like you can with TradeStation, where you can put the alerts and activation rules and things like that. There's a lot of those tools available here as well. So intra-market spread trading, again, is trading the exact same security, just different months. And you use the same type of technical analysis. I buy at demand, sell at supply, trade along with the trend, okay? And it works for the most part, high probability opportunities. Another thing we can do is look for what's called seasonal patterns. And there's a couple different ways of doing this. Typically for seasonal patterns, you have to subscribe, okay? MB Trader, no, I don't know what MB, this is TradeStation Futures Plus that I'm using. It's, yeah, Futures Plus for TradeStation. So you just have to contact them. So seasonality, basically what happens with a lot of these spreads is they repeat themselves over and over and over again every single year at the roughly the same times. And the big institutions are aware of this seasonality and they trade that. Matter of fact, right here, nearly every single security has a season that it goes through: spring, summer, fall, winter. Spring is slightly bullish. Summer is the strong bullish trend. Autumn is the end of the bullish trend, start of a downward move, and winter is the full-blown bear market. Everything goes through a cycle like that, especially things that are grown or extracted from the ground. So it's very common to be able to trade these seasonal moves. The big institutions do this, okay? So again, it's usually associated with commodities, but even things like the Christmas rally or sell in May and go away, those are seasonal sayings that are typically following through in the markets. I can go out again, you got to pay for the service to get the seasonal data usually, but I happen to use a couple different services. I'm not saying you have to use them, but logging into one, that's the wrong login ID. I think I forgot my password on this one. See if I guessed right. Oh, I did. Okay. Anyway, let's see. Here we go. I'm not going to show you the current ones, but if I go to previous trades, February, seasonal spreads, you can see that they find these high probability spreads. Basically, some of these are 100% winners over the last 15 years. Crude oil versus heating oil, or cotton versus cotton, lean hogs versus lean hogs, 93% winners over the last 15 years. Now, be careful. Just because it says it's 100% winner doesn't mean it's going to win all the time, and there are drawdowns. So in this case, you could see that, yeah, it was a 100% winner, basically buying gasoline and selling crude heating oil on February 7th till February 26th. But look what happens at times. There are times, yeah, this one won $676, but at one point it was down almost $1,800. So sometimes you can get some pretty big drawdowns you got to be careful of. That's why I look at this and I trade it using technical analysis. I just use this to identify what I might want to trade. So you can find some of these seasonal spreads. Like I said, you got to pay for the services that tell you them, or just simply observe. Now, when it comes to intermarket spread trading, I can either take profits or trade based on my technical analysis, or I can use that seasonal spread information to let me know approximately when I might want to enter or exit. And basically, there's a thing called co-integration, and co-integration is not correlation. Correlation measures how much two related securities move in relationship to each other. If they're very highly correlated, they should move very similar to each other, like the NASDAQ and the Dow, or the NASDAQ and the ES. They move together because they're both equity indexes and share components. Co-integration is a little bit different. They call it the drunk and his dog. Basically, when it comes to correlation, if contract A moves up and is correlated, contract B will also move up. If they move opposite, there's negative correlation. But basically, correlation measures how two things will move related to each other over time. Co-integration is a spread trading, basically. Okay. What happens is these spreads will change. The relationship between the two securities is pretty secure. They will widen and come together a little bit, or narrow and widen, but they'll always revert to an average. And it's kind of like a drunk person walking their dog. Okay. So what does that mean? Well, if you have two drunks that are walking down the street, going from different bar to different bar, they have no relationship to each other. And they'll stumble along their way, whatever way they go, right? It looks kind of like a chart where they're stumbling back and forth down the road. But a drunk walking their dog, the dog is tethered to that person. So while the person may move and stagger because they're drunk, the dog also has some independent movement as well, but they cannot go beyond the leash. They're tethered together, so they will eventually move down the road in the same direction. Okay, one can't move without the other because they're tethered together. Does that make sense? So with co-integration, that's how spreads work. You have, say, silver and gold, but both precious metals, they have a relationship to each other, but because of supply and demand, they can move at different paces. But overall, they will revert to their average, that leash that's tethering them together. They will both eventually move up or down long term together. But in the short term, they sometimes get too close or get too far away, and that leash will snap them back to the relationship. That's what we trade in spreads. And with intermarket spread trading, again, we have to use the notional value to chart it properly. And what we're doing is basically taking advantage of that relationship going out of the norm, then coming back. Your husband will understand the analogy. He gets drunk and walk the dog. So how do we trade these? Well, one of the ways of doing this is looking for abnormal relationships. Like I said, if I go back to my chart here, and I've got a chart of a spread right here, Russell versus NASDAQ. Let's change the time frame here. I guess I could use a 5-minute, but really, could use the 1 minute, but I'm going to go to a 60-minute and see if that populates. And then what I could do is add in tools. And we'll see, we'll put in Bollinger Bands as an example just for now. And hopefully that populates soon. For some reason, it takes a few moments for it to download all the data. Probably close the other ones. Come on. I should have gone to one of my other spreads that already had the chart on. I don't know why it's taking so long. Let's see, what was this one? This is a 4-hour June, September NASDAQ. That's an intramarket, but this will work as well. Again, I can bring the other one back up in a moment too. But again, if I bring up technical indicators, things like Bollinger Bands, as I said, there we go. What we can look for is when the bands are being violated, perhaps. You can see right here, we're closing outside the band, outside, 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 inside. Once we close back inside that band, what happened? Prices reverted back to the mean and eventually shot to the upper part of the band. Once again, close outside, inside, and should be reverting back to the mean. Well, unfortunately, didn't quite hit it. But when you get those extremes, especially if you combine this with things like supply and demand, which again is what I focus on, more of the trend and supply and demand, right there we have, yeah, I didn't go right. There we go, Ray, come on, edit. Trying to change this around a little bit to see it better. There we go. I went the wrong way. Didn't it? The right one? Nope, that's not it. Come on. Oh, well. Anyway, you can see right here, I was trying to draw this line and thicken it up, but there was an area of demand right here where prices had rallied from in the past, and that would have been a buying opportunity to buy the NASDAQ June versus September and trade the spread. And it moved, in this case, this is on a 240 candle. So this moved on what day? The 9th of April, 1 a.m., basically is when it hit, and it moved up 5 p.m. on the same day, and it moved from 149 to 180 something. So we're talking about 30 plus points times $20 a point. And what was the margin on this? A couple $100. So there's definitely great opportunities in the spreads if you know what you're looking for. And the same thing works on those intermarket spreads. I look for areas of supply and demand for prices to bounce. You basically can open it as a spread. Yes, you can close individual legs if you choose to. You can actually split it up. So right here for seasonal trade, we can enter on approximately the date of entry that the seasonal spread tells you to and place your stop maybe 1/3 of the average profit and target on the approximate date of exit or the average profit. You know, when I go to those picks, again, a lot of times it'll tell you the average profit of winning trades. Sometimes they'll tell you the average stop loss, but they have a really wide stop compared to that average win. That doesn't make sense. But typically, if I could see what the average win happens to be, or I actually could chart it as well to give me more information, I can identify what is 1/3 of that potential profit, and I'll place my stop at that level. It's just up to you how you want to trade it. So I don't blindly trade these seasonal moves. I analyze them with the technical analysis, analyze that chart to make sure I'm getting in at the right time and the right place. So again, the seasonal patterns, they give you intermarket opportunities. As you can see, I was just showing you that's gasoline versus heating oil. And you can look over the last 5, 15, even 30 years to see what is that trade pattern. And this year, I don't know if it worked quite as well. Let me zoom in more. You can actually zoom in on the date here. I'm not saying you need to buy this stuff, but if you're trading spreads, having seasonal data can be very useful. And if you drop my name, they give you a 10% discount on the yearly subscription on this MRCI. But if you're not using it, don't spend the money on it. You can try it out first. You can see this one didn't work out this year because we have the 5, 10, and 30-year history. Let me take those off. And that's the actual spread this year. What happened? It went down, not up. So this year you would have lost money on that one. And that was one that was actually 100% over the last 15 years. So this year it was a loser. Again, if I'm looking at intermarket, there's the knob trade, notes over bonds. And this was an 87% winner, intermarket spread, getting in February 17th, out on April 1st. Again, it looks like it's pretty good until you start looking at some of those drawdowns. I mean, I would have loved to make $11,000 on that one. It was only a drawdown of 6,250. We were actually profitable by 15,000, and then it gave some back. But then you get months or years like this, negative 5,400. It actually closed down 3,300. So you got to be careful. The average win on this trade is 21.28. And again, you can take a look to see how to do over the last 5, 10, 15 years. Is this something you want to trade? And look at this year. It actually didn't work out as well. It still profited, just not as much. There was the entry date. There's the exit date. It's definitely higher, but gave back a lot of the profits it had. So I timed this. This was the June Treasury bonds versus Treasury notes. Again, June. So if I were to go out and try to chart this one, you just go ahead and see. Where are you? Oh, I finally got the NASDAQ chart to show up. That was the NASDAQ Russell chart. Anyway, I can create those charts again. So if I do 30-year, there we go, 30-year, 10-year spreads. Perfect. And it's the June inter-product spread. So it actually had it already for me, and now it's not showing me the data. I might be doing the micros by mistake. But anyway, I could chart those to see exactly when I would enter, when I would exit by using this platform. I just have to type them in. But again, you got to make sure you adjust for the delta and the point values. In this case, it was crude oil 1,000 per point, heating oil 42,000 per point. Got to use those notional values for charting. So one of the primary purposes is to keep margin requirements down, yes. And it's not the only reason why to trade those, though, because the other reason is you have less directional risk. You're trading a different dimension of the futures. Instead of trading directional, you're trading the relationship between two securities going out of the norm. And they're very high probability trade opportunities. Again, if I go back to MRCI, or actually, I have another service I use. See if I can remember my login ID for this one. That's it. Nope. May not remember it because I have it saved in my other computer. Never mind. I was going to try to search for some others for us, but I'm not going to bother with that right this moment because I can't remember the password. So, like I said, when it comes to seasonality, there's a lot of different ways of looking at them. There's different services you have to subscribe to, or you can simply go through, create the spreads on your charts, and just see if there's opportunities coming up. So I can create that again. This one's what, gas versus oil July. So if I bring up open chart, we close some of the other charts. So I don't have too much running here. So that definitely is going to slow things down. It's this one. There we go. And here we are. So this is a 1 minute gas versus oil July. So I'm looking at gasoline versus crude oil, basically. And again, I can change time frames. Typically, when you're trading spreads, these are more swing trades, not day trades. So I went out to a daily chart. I often use daily or 4-hour charts. There we go. And it should hopefully populate pretty soon. But what I could also do is start adding in some of the tools that I typically use. I don't use too many technical indicators because I primarily focus on price, but I do use Bollinger Bands. And yeah, I'll leave that like that. And I also like to use my RSI as a momentum indicator. So I don't use it as the typical oscillator use. Is it RSI? There we go. And you'll notice I changed to 60 and 40 for my overbought, oversold. There we go, and create. And this is still getting all the data right now. But once it populates, I'll be able to go ahead and take a look at the chart and just see if there's opportunities. So again, while we're waiting for that, I can go to my other charts here and just kind of show you, which one was this one? This is the NASDAQ June versus September on a 4-hour chart. We actually did have a possible trade opportunity coming up here where we ended up closing outside the band, coming back in. We went back to the midpoint. I wouldn't necessarily traded that. Again, I'm looking for things like this where I actually have a pocket of demand that should prices come down and hit that area, they're likely to bounce from that area, giving me a buy opportunity with a stop below. And I traded directionally as a substitute because, again, the margins are lower. And if I'm wrong, the prices don't typically move as far and quickly against you because you have some protection. Remember, you're long and short on the security. So that's a little bit more on how to trade the spreads. If you guys have more questions, go ahead and let us know. You can email TradeStation. It's education@tradestation.com. So I'm going to turn this back over because we kind of run out of time here. Turn this back over to Jesus. And I want to thank you guys for your time. And if you have more questions about this, I'll be back again for more sessions, I'm sure. Let me know. Like I said, I do this on a regular basis. I trade these spreads almost every single day and keep an eye out for that. So thank you for being here.
Hey, thank you, Brandon. This is great information. Just a couple of reminders. We are doing a series. This is a part of a series, of course. This is lesson number 2. I think at the beginning of the presentation, I showed you where you could find those presentations, but I'll do it again. You go to TradeStation.com, and actually it's not linked from TradeStation.com yet. So you're going to have to use the link that I shared to the Futures Education Center. Let me go ahead and share that with you one more time. Give me just a moment. There it is. So you go to that link that I just shared in the chat, and you'll find the sessions for the FuturesPlus Masterclass. We did lesson 1 a few weeks ago. The video is already there. This one was recorded, and we're going to post it in the next few days. Just give us a few days for the recording to go through production and compliance, and we're going to post it, in a few days. So just hang on tight. On the event calendar, though, we have the next session. So if you want to register for lesson 3 and beyond, just make sure that you go to the events calendar and register for those sessions. So again, Brandon, thank you for your time. Thank you for your expertise. And I look forward to seeing everyone in one of our future classes. Have a wonderful afternoon, everyone. See you next time.